Tariffs are a tax paid by the companies that import products into the United States. That is the official definition. That is what the government says. That is what most financial media repeats every time the subject comes up. It is technically correct, and it is one of the most misleading things you will hear about the American economy in 2026. Because the question is not who writes the check at the border. The question is who ends up paying for it. And the answer to that question is the thing nobody in the tariff debate wants to say out loud. You do. Not the importing company, not the foreign manufacturer, not Wall Street. You at the checkout line, every single time. Today, we're going to explain exactly how that happens. Not the politics, not the trade war narrative, just the mechanism. Step by step, dollar by dollar.
To understand what changed, you need to understand what the system looked like before. For most of the last 3 decades, the United States operated under a trade framework built around low tariffs and open markets. The average effective tariff rate, the actual percentage collected on imported goods, sat below 3%. That number held relatively stable across administrations, across party lines, for roughly 30 years. The logic was straightforward. Cheap imports kept prices low for American consumers. Companies could source components globally and keep production costs down. The system had winners and losers, but for most American households, the visible effect was simple. Prices on manufactured goods stayed manageable.
Then, in 2025, that framework was dismantled. The average effective tariff rate on U.S. imports rose from under 3% to approximately 17%. That is not a policy adjustment. That is a structural reversal of the entire trade architecture the American economy had been built around for a generation. And it happened fast enough that the supply chains, the pricing models, and the household budgets on the receiving end had almost no time to adjust. The question that matters now is not whether that was the right policy decision. That is a political question. The question that matters is, what does a move from 3% to 17% actually do to the price of the things you buy? And who absorbs that cost? Here is where the official narrative breaks down. The standard explanation goes like this. A foreign company sells a product to an American importer. At the border, the importer pays a tariff, a percentage of the product's value, to the US government. The foreign manufacturer loses business. The American government gains revenue. American consumers might pay slightly more, but the burden falls primarily on the foreign exporter. That story made sense when tariff rates were 3%. At 17%, it does not hold together, and the data proves it. According to research from the National Bureau of Economic Research, the pass-through rate of current tariffs to American consumer prices has already exceeded 50%. Which means more than half of every dollar collected in tariffs is being paid, not by the foreign manufacturer, not by the importing company at the moment of the transaction, but by the American household at the point of purchase. Goldman Sachs projects that the current tariff regime will add approximately 1% to overall consumer price inflation across 2026. That sounds small. It is not. On a household spending $60,000 per year on goods and services, 1% of additional inflation is $600 every year, silently, with no line item on any receipt that says tariff cost X dollars. It just shows up as prices that are slightly higher than they were, on everything. So how does the money actually travel from the border to your wallet? There are 3 decision points, and at each one, the same choice gets made. The first decision point is the importer. A company that brings goods into the United States pays the tariff at customs. That is a real cost. The question is whether they absorb it, accepting lower profit margins, or pass it on to the next buyer in the chain. In theory, a company with strong enough margins and a competitive enough market might absorb some of the cost to protect market share. In practice, when tariff rates jump from 3% to 17%, the increase is too large to absorb without destroying the economics of the business. So importers pass it forward, almost entirely. The second decision point is the wholesaler or retailer. The company that buys from the importer now faces a product that costs more than it did before. Same choice, absorb the cost or pass it on. And here is where something important happens. Retailers do not just pass on the tariff cost, they apply their standard markup percentage on top of a higher base cost, which means the tariff gets amplified as it moves through the supply chain. A 17% tariff at the border does not produce a 17% price increase at the shelf. It produces a larger one because every link in the chain applies its margin to a higher number.
The third decision point is you. By the time the product reaches the retail shelf, the tariff cost has been passed through, marked up, and embedded invisibly into the price. You have no choice to make. You either pay or you do not buy. And for essential goods, food, household products, clothing, electronics, most people pay because the alternative is going without. That is how a tax paid at the border becomes a tax paid at the checkout line. Not through any single dramatic moment, through 3 quiet decisions made by 3 different businesses, each acting entirely rationally in their own interest. Now, here is the part that does not make the headlines. Tariffs are not a neutral tax. They do not hit every household equally. They function, in economic terms, as a regressive consumption tax, which means they take a larger percentage of income from households at the bottom of the income distribution than from households at the top. The reason is simple. Lower income households spend a higher percentage of their income on goods, physical products, many of which are imported or contain imported components. Higher income households spend a larger share of their income on services, healthcare, financial advice, education, travel, which are largely domestic and largely insulated from tariff effects. So when the tariff regime raises the price of groceries, clothing, appliances, and electronics, it hits hardest on the households who spend the most of their income on exactly those things. A household earning $40,000 a year, spending 60% of that on goods, feels the tariff burden in a completely different way than a household earning $200,000 a year, spending 20% on goods. Same tariff rate, completely different impact depending on where you sit in the income distribution. And here is what makes this particularly significant for anyone thinking about long-term financial planning. Tariff-driven inflation does not show up cleanly in the official CPI number. It gets blended into the broader basket of goods and services. It gets offset by falling prices in categories that are not affected. The headline number understates the experience of households that are concentrated in the goods categories that are actually being hit. Which means the inflation you are living is higher than the inflation being reported, again. So come back to the original question. What do tariffs actually do to your wallet? They add a cost at the border that travels invisibly through 3 layers of the supply chain, gets amplified at each step, and lands on you as a price increase on goods you were already buying, with no label, no line item, no explanation. The companies in the chain pass the cost because it is rational to do so. The government collects revenue at the border and calls it protecting American industry. The financial media reports the policy debate, who is retaliating, which countries are negotiating, what the trade numbers show. Nobody explains the mechanism. Nobody draws the straight line from the tariff rate to your grocery bill, to your household budget, to your ability to save anything at the end of the month. That line exists. The data confirms it. And the reason it does not get drawn clearly is that drawing it clearly requires acknowledging that the current tariff structure functions as a consumption tax that is paid disproportionately by the people who can least afford to pay it. The financial media will not tell you that, but that is exactly what this channel is here to do. If you want to understand the economic forces that are actually shaping your financial life, not the version that makes it into the political debate, hit subscribe, because this is just the beginning.